The world is shifting at a dizzying pace. Yesterday's allies are treating each other like mere acquaintances. Former adversaries are inviting each other to dinner tables. And in the backdrop of all of this, the entire global economy is getting reshaped. Hey investors, welcome back to another episode of Vishal Wealth View, a channel where we manage a seven-figure portfolio with an aim to grow it to eight-figure. In this year so far, we have made new investments in defense sector and Lloyd Metals and Energy, starting from a total profit of zero in the beginning of this financial year. As of now, our stock portfolio is sitting at a 5% unrealized gain and about 2 lakh of realized gain. Talking about our mutual fund portfolio, from the beginning of this year, we were able to capture almost 10% of unrealized profit, which is equivalent to about 9 lakh. So, in today's episode, we'll be diving in deep into this trade war. What are the repercussions of this trade war and which sectors will be impacted the most? What is government planning to do? And which sectors are likely to benefit because of these government policies? So, without wasting much time, let's start this episode. First, let's try to understand what is a tariff and a trade war, and when do countries actually start this. So, tariff is just a tool that countries uses to protect its domestic industries. These industries might be vulnerable or might be owned by certain class of society that don't want it to be affected, and it's a tax that's paid by the citizens of the country whenever they're importing certain items from other countries. Now, why do countries actually start trade war? The main reason lies because they want to decouple their economy from their adversary. Right now, US and China are in a sort of a trade war. However, Trump recently announced tariffs on all the countries, adversary, allies alike. And as of now, India has slapped with almost 50% tariff, and the tariff rate is going to impact certain sectors of Indian economy. As a preventive measure, Indian government has been in the conversation with Europe, I think so, for free trade agreement, and they're also planning GST cuts after Diwali. So that's going to impact some sectors, or is going to be a relief for some sectors that's going to get impacted by these tariffs. Along with that, there are new avenues for trade that is getting renegotiated. There was a news that came out in the past few weeks where India and China was planning to open land trade routes. So there is a mixed bag and a lot of uncertainty around the markets and the world because America is imposing tariff and Indians are also taking preventive measure to make sure the sectors that are impacted have other markets where their products can be exported. So let's try to understand which sectors and which stocks are getting impacted by this tariff and trade war. So this is my portfolio as of now. The current total value is at 67 lakh. Almost 75% of my investments are in ETFs. I shifted my mindset to have a more index-based approach towards wealth building rather than picking individual stocks. And I only pick individual stock when I find them a really good business with a good amount of moat and I'm getting it at a right price or a decent price. The worst performer in my portfolio is Anantraj, and the best performer is Motilal Oswal Nasdaq 100 ETF. I have been cutting down on this position. I built position in this index back in 2022. And since the tariff war has started, I have rotated this capital into defense index. And as of now, defense index is almost 11% of my portfolio. The largest holding in my portfolio is index called ICICI Momentum 30 Index, which is a index tracking 30 companies in Nifty 200 space with the highest momentum score. So now let's try to understand which of these holdings in my portfolio will be affected by these tariffs and GST rate cuts. So as per Nifty GPT, Varun Beverage, Suntek Reality, Metals, and HDFC Bank are the stocks that will be impacted. Then it's also recommending me that Motilal Oswal, Motilal Alpha, Kotak Alpha ETF would also be impacted because of these. So let's try to understand what's the reasoning behind this. So Varun Beverage will be impacted because of the GST rate cuts. Lower GST on soft drink excise will boost margins. The stock is already down, but I think there was a catch in the policy that carbonated drinks are going to get charged higher GST, which would be considered as like not healthy for population. That's why Suntech Reality is also going to have an indirect impact because of these GST rate cuts on construction service, and they can have better margins and improved demands because of this. So is the case with Lloyd Metals and Energy. The price is down, and the recent tariff reductions on imported raw material is going to improve the margins for this particular company. HDFC Bank has a minimal impact because of this GST change, and this particular rally is mainly driven by the credit growth in this entire company and the bank. Other holdings will not be impacted by this. So let's try to understand what will be the impact on Varun Beverage, and is it a good time to purchase this stock and build position in this particular company? Some of you might not know, but Varun Beverage has a special partnership with PepsiCo, and they are only allowed to manufacture brand PepsiCo's product, I think, in Asia, some countries in Africa, Nepal, and Sri Lanka. And they have a contract till 2039 that they can only exclusively bottle PepsiCo product in Asian continent. So this builds a really good moat around WBL's business. So let's try to understand what are the result for this. So FY 2025 interim revenue is standing at 7165 crore, and FY 24 revenue was at 482 crore. Now, if we see what are the management guidance given in the latest con call, they are expecting a revenue growth of about 24%, and the EBITDA margin are going to expand, and profit after tax also increase in the latest con call. Now, the new DRC plant, DRC is Democratic Republic of Congo. It's at 100% utilization, and they're planning a second plan and a proposed 7,500 QIP for to fund capex. I think they came out with this QIP back uh, in 2024, and they were planning to expand their factories in African continent so that they can get more sales from them. So Indian market and African market is going to be the primary target for Varun Beverage, at least for their carbonated drink business. They might get some amount of impact because of GST on certain carbonated drinks, but African market and other product always are going to benefit from the GST rate cut. So let's ask this. So as of now, for VBL, 75% of the revenue is coming from just carbonated soft drink, and 21% is coming from packaged drinking water. And the planned GST reforms are going to like take the tax rates from 18% to 5%, and from 5% to 2.5% on specific select essential categories. So the lower taxes are expected to push up the domestic consumption volumes, and analysts are projecting almost 5 to 10% rise in the carbonated soft drink volume sales. So you have to remember, India is a tropical country. Summer is always extreme in our country, and that's why the sales of carbonated drink during the season of during the quarter of May to September is always a bit high, or like during that entire summer season. Apart from that, VBL joined with venture with White Peak Refrigeration. Okay, I don't know about this company, White Peak Refrigeration, and its plan to manufacture Visi coolers could benefit from lower packaging and logistic costs, potentially widening margins. So this is also an avenue that can also lead to increase in price for WBL. Now, I'm not sure why the stock price is falling right now. I think since last 1 year, the stock price has been correcting, and to some extent, this is like cause and effect of high PE ratio at which this company was trading in the past. So overall, GST rate cuts can impact the sales volume and can increase the sales volume for a FMCG company like VBL or even HUL. So let's try to understand what are the chart patterns that are forming in Varun Beverage as of now. So the recent chart panel show that both the patterns are bearish in nature. One is descending channel, another is head and shoulder pattern that's forming. And as you can see in both of these channels, they are bearish in nature. The stock price is still expected to fall at least to its nearest support. And I think I'll probably wait for some amount of time. At least it should hit its near term support before I start investing in it again. But this is a good opportunity. This is a good company. It's trading at a premium, but I want to understand what is the fair value for this business so that I can invest for long term. I want to conclude whether it makes sense for me to invest more in this right now, or how should I approach my investing in this particular asset as of now. So Varun Beverage is showing top line growth of 7164, which is almost 24% up year on year, and it's indicating solid profitability, but the free cash flow remains negative as of now, which could limit future expansion unless planned 7,500 crore QIP is raised and deployed efficiently. So they are going to make sure the negative cash flow can get covered by the QIP or the public market proceeding, for which they're coming to market to raise money. The valuation is high, definitely. The PE is around 60 and the price to book value is around 10, which is again significantly high, suggesting the stock is trading at a premium relative to its peer. I completely agree. Now WBL technically is below its both 50 and 200 DMA with support near 450, 460. I think we have seen that in the chart pattern analysis. And the recent news largely is neutral to positive, and the company is also announcing new joint venture with Cooler. I think there was this company called White Peak Refrigeration, and the greenfield plants in DRC, Democratic Republic of Congo, which is a country in Africa, and then a QIP proposal. So there are some like positives about this company that can lead to a future growth, and the domestic volume headwinds from heavy rainfall and potential competitive pressure in the this uh, FMCG space add risk. So monsoon has been pretty violent in India, at least in northern part of India this year, and this can affect the sales volume. That's completely relatable because if the farming season is not good in India, then the lower segment of the country is not going to spend a lot on carbonated drinks, so the sales of this company is going to get affected. So, given the high valuation, negative free cash flow, and short-term technical weakness, adding more positions should be approached cautiously, considering dollar cost averaging strategy, or wait for a pullback to a stronger support level before increasing exposure. So, I think the stock is in correction phase. So, I'll take this strategy. I'll start building small positions in this over a course of next 3 to 6 months, up until like December. And I think that would be a good strategy for me to invest in this company or rebuild my capital, because I'm already holding some amount of stocks and I don't want to have an overexposure in this just one asset, because the growth rate for this is still going to be higher than the other FMCG peer because they have the entire African market in its hold. But again, carbonated drinks are subjected to higher GST tax, and I don't know how this turns out to be. So, to minimize my risk, I'll dollar cost average in this equity over a course of next 3 to 6 months now. Now, the second stock that really impacted my portfolio by these rate cuts and tariff was Suntech Reality. Now, as of now, the logic that's like leading to this effect is the GST cut on construction service may improve the demand and can also improve the margins. So let's try to analyze what is Suntech Reality all about. So as you can see, in FY25, the revenue was at 854 crore and it has been growing with almost 40% year on year increase. The net income was up almost 113%, but back in the day, the stock was trading at a PE of 80. Now the PE is just correcting, and now it's trading at a PE of about 40. But clearly, revenue, income, both are growing. Let's try to also see what is the like sentiment and are there any risk involved. So there is no major red flag or no like negative news that's affecting this particular stock. I think on August 25, India 28 listed reality firms sell properties worth of 53K crore in April to June. Prestige Group leads. Okay, so what is the recommendation? Centric Reality combines solid earning growth, strong cash generation, and attractive pipeline. Recommendation buy with a target price of 650 to 700. Okay, and a protective stop loss near 380, confidence high, upside high for upside, moderate for risk due to valuation and liquidity. Also, let's try to analyze what are the chart patterns saying. I'm already holding a decent amount of capital in my portfolio in this particular asset. I'll be bit cautious increasing like more bets in this because it's already 10% of my portfolio. Even most of the sentiments are positive. I don't see a major downside risk, and the downside protection is also pretty good for this company. The company right now is trading at about I think it's trading about a valuation of 5,000 crore, and it still has a revenue of about 1,000 crore. So, which is again a good number for a luxury real estate company. So, one is bearish channel, but there is also a bullish channel that's forming, which is cup and handle, which basically indicates that the turnaround is happening, and it might be a good time to just pull for a short term trade. So, what am I going to do about this? What am I going to do about this? What am I going to do about this? Uh, yeah, so as of now, I think I'll not build more capital in this or build more, allocate more capital to this because if I see my overall portfolio, still Suntech Reality is about 10% of my portfolio, which is an overexposure in my overall portfolio. I think I'll probably sit and wait now. I have been sitting on this investment for almost 2.5, 3 years now. What's harm in sitting for one more year? But as soon as I see major red flag, I'll try cutting down this position. But this business has been running pretty normally without any major noise or major red flag over past 2 years, and that's why I think I understand this business pretty well. Not as good as like everyone, but yeah, I think I like to hold this company, but not increase, even though there is a short-term bullish channel that's being forming. Now, the third company in my portfolio that will be impacted by these tariffs is Lloyd Metals and Energies. Now, this is a company that's operating in production of iron ore and steel. And the recent tariff reduction on imported raw material duties could lower the cost base for this particular company and potentially offer a better margin. So, let's try to understand what is Lloyd Metals all about. So, as of now, the stock's trading at about 1314 uh, rupees, and it has a P of almost 47, which is pretty high for a commodities company. I'll say this company does not have a brand presence in the head of consumers, so demanding a premium valuation will always require absolutely amazing growth opportunities and growth prospects. So in one year, the revenue just grew by 3%, which is not significant. The net profit jumped by 16% and EBITDA jumped by almost 45%. That means in the business model in which they are operating, there's a huge amount of depreciation component that might be involved. That's leading to like low profit, even though the revenue or like the EBITDA increased significantly. Now, if we see uh, what are the red flags and what are the recommendations about this? So as of now, I'm sitting on a loss of about 14% on this investment. So Lloyd Metals and Energy exhibit strong profitability, solid balance sheet ratio, aggressive growth guidance, but the stock is trading at a steep valuation multiples and has slipped key moving averages, indicating a short-term weakness. Okay, let's try to analyze the chart pattern for this. Like how what chart patterns are forming in Lloyd Metals and Energy as of now. Okay, so both the chart patterns that are forming in Lloyd Metals are bearish in nature. One is head and shoulder that's forming. Second is descending triangle that's forming. So both the channels are bearish in nature. I don't think I'll be building more capital in this as of now. I want to look for a consolidation phase. Let's try to also understand what's the growth prospect of this company. So in the past, the company has been growing at a 78% like revenue. It was able to grow its revenue by 78%, but past results do not always translate into future results. So we have to take them with bit of a caution. What are they saying now? The company is expanding capacity with an 85-kilometer slurry pipeline, new sponge iron plant, and 1.2 megawatt wire rod mill, all on schedule, good thing. Capex remains strong at 1714 crore in H1 FY25, while the firm expects to maintain a high margins operating 27% and gross margins of about 87%. So one good thing about this company is, compared to all the other commodities companies or companies that are operating in commodity space, somehow they are able to enjoy really high margins. Now, I have not deep dived into it, like why this company has, or this business has a better margin, about like more than 15% net margins, which is pretty rare in any big business. Uh, so management remains optimistic, citing stable iron ore prices and increased demand for high quality ore, and reaffirmed a cyclical proof steel business outlook. Overall, the growth prospects are positive with continued expansion and strong profitability, but valuation remains high at PE of 50. Let's try to see the summary of the latest con call. What were the management saying? What was the major questions? Uh, Okay, so the key takeaways are from that 55 metric ton slurry pipeline they have commissioned, 4 metric ton of pellet plant. Sorry, not slurry pipeline, the pellet plant. The Q1 delivered strong financial. EBITDA margin was at 33% and PAT up by 14% year on year. Strategic minority stakes in West and East Coast pellet assets secure a coast to coast footprint and future export potential. Okay, that's a good thing. Aggressive capex, almost 8 billion rupees per year, funds BHQ beneficiation steel plant logistic, aiming for 22 to 26 metric ton of mining targets. Management is confident in logistics network to meet EC demand despite monsoon, leveraging pipeline, rail, and truck capacity. The major management announcement are commissioned of slurry pipeline by 4 metric ton. I think that's fine. What are the analyst question? Key question that can be interesting. So why did the Lloyd take 19.4% stake in Mandavi River Pellet despite limited control and the pellet investment aimed at feeding its own steel plant, becoming major external pellet supplier? So the management said that the stake was acquired to book value and secure strategic foothold in West Coast. I think they have said that in the key takeaway. How confident is management achieving 22 metric ton mining target for FY26 given the monsoon constraint? The management outlined that 2.5 metric ton will be moved via the new pipeline and the remaining 12 metric ton would be evacuated through 3 operational railway sliding. Again, this is a guidance. The key insight is they are providing assurance on logistic capability to meet regulatory mining limits and key operational, which is a key operational risk for this sector. Apart from that, what are the cost saving impact will the Triveni slurry pipeline and internal logistics subsidiary have on EBITDA per ton, and can EBITDA per ton reach 2,800 crore in the next 2 quarters? The management indicated that the pipeline will save almost 500 600 per rupees per ton of for 10 metric ton of iron ore, with additional saving from logistics subsidiary. While the current EBITDA per ton is around 2000 crore, they expect incremental improvement but stopped short of guaranteeing like the target of 2800 crore. Now, a lot of management does that because even though they are confident that they'll be able to hit that target, they don't want to pre-announce it, because when the results when they're not able to meet the results, it just decreases the confidence on the company's management. So usually good management are always cautious before giving strong or definite targets. Now, the fourth stock that will be impacted as per Nifty GPT was HDFC Bank, but it said that GST will be having minimal direct effect on this. It's a possibility since folks have more cash in hand, they'll be spending more. Maybe the credit growth happens, then this company is poised to benefit, but there is no direct benefit on HDFC Bank because of this GST rate cut policy. Same with Kotak Alpha. I think this is a pretty diversified stock basket. I cannot just allocate one policy to affect the entire index. So this is also primarily a fund, and GST tariff rate shift might have an underlying effect on holding. So I have to analyze individual holding, but I think I'm going to rely on dollar cost averaging or rupee cost averaging and keep on investing in these indexes. Other holdings will not be impacted as per Nifty GPT, and I think I have been decoupling my portfolio from these tariff impacted sector to large extent. The only investment I made, which I was aware that is going to be an export oriented sector or export oriented company, was Lloyd Metals and Energies, but they were in a zone where they were starting to export rather than these tariffs affecting their exports. So that's why I think this was a good bet, and they had shown significant growth in the past. So I wanted to understand more about the business. And that's all what I have for you for today's episode. If you find this video useful, do hit the like button and subscribe to Vishal Wealth View. Bye bye, stay safe, and happy investing.